And so anyways, I started building a community in Houston, where I was at the time. And by the end of 2013, I decided to make it my full-time focus. It's really all I've been doing since then. And long story short, I've consulted a lot of companies in that space. I've started quite a few of my own. And then for the last 3 years, the advisory services, the consulting services have continued, but I spend most of my time at a broker-dealer, investment bank. We're also an RIA. We do digital securities ratings and private company valuation. We run an OTC desk for crypto. And so we're really kind of a alternative investment, ecosystem, one-stop shop. And I have my hands in every division of the company, leading kind of biz dev strategy, corporate development. And even though some of that falls into areas that don't have to do with crypto and blockchain, a lot of it does. And so it makes it fun for me. So I've spent a lot of time over the years talking to people about what cryptocurrencies are, why you should be interested in them, how you may want to interact with them, whether it's as an investment or as an actual tool that you can use to innovate or to improve existing systems. So starting from the beginning, we'll touch on the very, very basics, and then kind of talk about what's possible. And then I'll give you a bit of expertise, a little bit of my thoughts. And I pull some of these things from other decks that I've seen and have worked on. And I'll kind of give you a vision for kind of where I see it in the world of finance, at least from my perspective. So a blockchain. All cryptocurrencies utilize a blockchain. Well, most do. There's variations of what a blockchain is technically, but for the most part, they are shared ledgers that many computers on a network talk to, and they all make sure that they have the same ledger, and they all have to agree that their ledger is the same as everyone else's, and that it's the right one. So, it's a little boring. It's just a system of credits and debits, but and why is that a big deal? Well, all of the Western writing systems have their origins in ledgers, and this is a Sumerian tablet from 3000 BC, and this is accounting. So the double entry bookkeeping was developed in the Middle East and during the Middle Ages, and really we haven't improved upon that for a very, very long time until recently. Double entry bookkeeping, as we all know, it's more accurate accounting. There's audit trails, there's error reduction, and it served as the bedrock for the modern corporation. With a blockchain, most I think believe that will also have a major disruptive impact on business, on finance, on civil society, on governments as well. And so that's why an innovation of a ledger is so important. So when I've got to pop up, there we go, thank you, go away. When we talk about blockchains, there's different types. And when we talk about cryptocurrencies, there's hundreds of them, thousands of them technically. But it's important to differentiate in the different types of blockchains that we can utilize. Public blockchains are blockchains like what Bitcoin runs on. In the crypto space, we call it permissionless, meaning no one has to give anyone permission to access it, use it, do whatever they want with it. If you want to use it to transfer some value but from yourself to someone else, great. If you want to be malicious and attack it, you can. No one's going to stop you. No permission required. and these are truly decentralized blockchains. And now we have other types that we refer to as being federated, private, hybrid, consortium, and these are all flavors of some control on it, whether that be the people that are validating the transactions are limited to a set group of people, or even if you want to look at it, interact with it in any capacity, you have to be allowed in. And so as we can see on the left side of the screen here, these are equivalent to intranets of the 1990s, right? So we remember when companies had intranets and you only got access if you were a part of the company. And so these are kind of that, and they're analogous to that. So when I'm talking about blockchains and I'm talking about cryptocurrencies, I'm usually going to default to Bitcoin because there were cryptocurrencies around before Bitcoin, but they failed because of some inherent flaws. It was very, very difficult problem to figure out, to try to create a digital version of cash that actually works. And Bitcoin was the first one. To this day, it has a larger market cap than any other cryptocurrency. So it's kind of what we were in the crypto space refer to by default in terms of good examples of the systems that work. So with Bitcoin, it was modeled after scarcity, commodity scarcity like gold. It's a protocol that uses cryptography to create digital property. It's a bit of a complex statement there, but a protocol is nothing more than a set of rules that computers use to interact. So when you send email, that's going out over a protocol that was developed just for sending an email. When you go to a website, whenever you load your website, you type HTTP or HTTPS, that's a protocol. And it's a protocol that was created specifically for serving a web page. Bitcoin is a protocol. And it's a standard set of rules that says this is how we're going to transfer value between two people and record the debit and the credit. That's it. Now, what makes Bitcoin so unique is its proof of work process, which we also refer to as mining. Mining, if we want to dive into that during the Q&A, we can. And it's a distributed timestamp asset ledger, which is the blockchain. And we can get more into what exactly that is and how it works if you guys want. But it's a distributed ledger of all the transactions of that asset. And the brilliant thing about this is that you can transfer this value without a trusted third party. The only other way you could ever do that, I think, is with cash. Because as soon as you introduce anything other than cash, where I'm just handing the counterparty the asset directly, there has to be a third party. And this is the first time we can transfer value without a third party to literally anyone or anything on the planet. So the properties that really separate this from, that make this significant is that it's decentralized. It's immutable being unhackable, cryptographically secure, it's borderless, near instantaneous, and is automated. So when you do send somebody cryptocurrency, whether that's on a public blockchain, a federated, a private blockchain, doesn't really matter, they all kind of work the same way. I like to describe the way that it works similar to email. Right, so if I send you a bank transaction of some sort, I can claw it back, right? If there's something wrong with it. Have you ever sent an email and clawed it back? Once you hit send, it's gone, right? You've sent it. And Bitcoin's the same way. Cryptocurrency is the same way. Once you hit send, that's it. And so in the way that you give somebody your email address to receive an email, you give someone your Bitcoin address to receive Bitcoin or any crypto. And in the way you log into your email with a password to be able to send emails, with Bitcoin, you have a private key and you have to own that private key in order to send the Bitcoin. And this is whenever you're holding the Bitcoin directly yourself. There's other situations where you have companies like Coinbase, that I'm sure many of you have heard of. They act as a custodian, like a bank, for your Bitcoin. And in that situation, you actually don't own your private key. So therefore, you don't actually own your Bitcoin. They hold it for you, and they show you how much they're holding for you. But when you're actually transferring cryptocurrency without a third party, it works a lot like email. And people ask, well, why does it have value, right? It does something that we've never quite seen before. There's a lot of companies that exist solely on the internet. And when we think about email, we've never thought about the I don't know if you guys have had to plug in your email server information into like Outlook in order to be able to send emails, but it asks for a thing called SMTP address. SMTP is the protocol for sending an email. That email protocol has no value. It's free, it's available to everybody, and it's just what we use. It's like a utility. It's free. It's if you have a server and you install the right application onto it, and you can send emails. But the email protocol has no value, right? The HTTP protocol that offers you a web page has no value. So therefore, what has value are all these companies that build applications on top of these protocols. And so that's the way it's been, right? Gmail has value because it's the application on top of the email protocol, right? Facebook has value because it's the application on top of this protocol that delivers a web page, and that web page has conversations with friends and pictures of your cousin. But with blockchain technology, we've achieved something very different. And that is that the protocol itself, that protocol layer, is where the value resides. That's why Bitcoin has value. And the application layer on top of it, it's free, it's open source, it's auditable, because the value is in the protocol layer. So we flipped where the value resides. And this is really important because it allows us to actually own the underlying technology that drives the usefulness of what we create on top of it. And that's really, really important to understand that, because it helps. Can you have value in the application layer? Absolutely. You can monetize stuff at the application layer. But if you own interest in the underlying infrastructure that makes that application be able to even do it, what it does at all, then just by owning that protocol layer, owning a piece of it, then we win as an investor. You win in the upside of the success of all applications built on top of it. It doesn't matter how many there are, or that you have to pick the right one as an investor for it to do well. And that's where smart contracts are very important. So I've been talking about Bitcoin. Second, probably most relevant blockchain out there is the Ethereum blockchain. For you that have your video on, just raise your hand if you've heard of the Ethereum blockchain. Okay, maybe half. Ethereum took the idea that, well, I'll back up for a second. Bitcoin was originally created to be digital cash. What it's really turned into is a store of value. And it doesn't have it has some functionality, some programmability, but not a whole lot. It's really a store of value. Ethereum set out to create something similar to a computer, something that can do really, really complex business logic, and something that anyone in the world can use, and it can never be shut down. Rules cannot be changed if you define those rules, and allow people to interact with financial systems with no borders, no permissions allowed, right? Or no permissions required. And so it's a global computer is what it is. And so that's useful for a lot of reasons. And for example, today we're seeing public equity tradable and turning into derivatives. We're seeing instruments that produce yield, all happening on the Ethereum blockchain. And the way that all happens is that Ethereum has a protocol layer, right? It has a cryptocurrency called Ether, and that cryptocurrency is required to do all this really nice, complex and extravagant things within an application. But you can hold, you can own the cryptocurrency that makes all that possible. So by owning Ether, the cryptocurrency that makes the Ethereum blockchain possible, you can own a piece of this entire ecosystem and its potential growth in the future, and how it might disrupt massive industries. And so it's a really interesting thing that we can suddenly put value into this lower layer. These smart contracts that make the Ethereum blockchain useful allows you to you can create assets and allow anyone to interact with them. And they process business logic. So if you think about how a company manages its money, and how that company has its receivables, payables. Think about the counterparties that a business interacts with in every way. Imagine if you could put every one of those counterparties and every one of those vendors that interacts financially with the business and put them all into a system where they're interacting with a smart contract. You can automate everything. There's companies that are achieving this right now. It's really interesting. And this is all possible because of these smart contracts where you can program a system to control assets and money programmatically with business logic. So the reason all this is useful for businesses and thinking about how you use blockchains and smart contracts, risk reduction can reduce hassle when it comes to compliance requirements, lowering fees, again, borderless, as I mentioned. Nothing can be counterfeited. It's literally impossible. Dilution, yes, you can make things dilutable, but if you don't want them to be, they cannot be. And there's no risk of identity theft because the very nature of the way you interact with it makes it impossible. And so the way that we see companies, looking at this technology, right? Because Bitcoin is a store of value. Ethereum is a tool. And if you think about it all as a tool, then you can use this technology to do things that couldn't be done before. The reason you want to do this, though, has to be, I think, very well justified, because when you create systems using blockchain technology, it's much more difficult than the way we would build systems before. So if we're thinking about how a company conducts business in e-commerce, if we're thinking about land and mineral rights, which I created a company and attempted to disrupt that space at one time in 2015. The technology makes sense. but sometimes there's use cases where you kind of you do a cost analysis on it and it doesn't. So these are some use cases where it does make sense to deploy this technology. And we can revisit this if you want and talk about specific use cases. On regulation, and I know I put a couple slides in here on this because it means different things to different people. If you're a CFO, I don't know where it may fall for you, but for me, working at a broker dealer, securities are everything. And so, back when Jay Clayton, the SEC chairman, he said distributed ledger technology may in fact be the next great disruptive and productivity enhancing economic development. This was an important moment. I always pay attention now to Gary Gensler at the SEC and what he says about cryptocurrency and Bitcoin and Ethereum, and because they have repercussions, good and bad, across industries in the US. So just a quick snapshot of some cryptos here. The takeaway here is that the IRS treats virtual currencies, as they call them, as property subject to cap gains tax. CFTC determines that they're commodities. So depending on what you do with it determines what it is and how it's treated. The SEC did say Bitcoin and Ethereum are not securities. I think those are the only two cryptocurrencies that they've actually issued that statement about. But beyond cryptocurrency, which so far we've talked about Bitcoin and Ethereum's cryptocurrency, which is called Ether, you can, like I said earlier, there's like 1,000 blockchains, right? So there's 1,000 different cryptocurrencies. And there's all different, and they come in different types. Some are called payment tokens. You can have utility tokens. Think of a ticket at an amusement park, how you use it to go on a ride, or a coin at Chuck E. Cheese and use it to play a game. These are utility tokens. They're not actual money. And then we can also create assets on a blockchain that can represent securities. And this is what I do a lot at the broker dealer. We work with issuers that are looking to digitize securities. And going down that path, we can start doing things like structured products, security derivatives, cryptocurrency derivatives. That arrow is supposed to be going from digital securities out to that subset list. And this is why you do it, right? You can have greater liquidity, you can make things more affordable, no international barriers, it's programmable governance, which is really unique. You can fractionalize the shares. And so where I think about creating assets on a blockchain, I look at capital markets and think about how there's tons of friction and how we can start removing that. And this isn't using Bitcoin, but this is using the technology, maybe in a public decentralized sense, maybe in a private controlled sense of the word, like in terms of how we use the tech and deploy the tech. The takeaway here is that there's all these problems to fix. And this graphic is from late 2019. Now the cryptocurrency market cap is closer to $2 trillion. So it's moved up quite a bit in this graphic, but the point is that it's actually still very, very small. And if you go back to thinking about how we embed value into that protocol layer, what I see is that if you put assets onto a blockchain, and if that blockchain can deliver a better solution, then the value that's going to end up residing in blockchains is going to be larger than pretty much anything else. Like it will be where most of the value resides eventually. So if we look at all this friction for issuers, for investors, and within the infrastructure itself, then if we digitize capital markets, then we can actually solve most of these problems. We can revisit this if you guys want to look at this. And Jeff, I'm sure we can share this and everyone can take a closer look. I just want to get to Q&A and make sure we have time for everything. And so this digitization is actually underway right now. I remember in early 2015, when I started hearing about Barclays, Citi, Goldman Sachs, they started experimenting with blockchain technology, and they started hiring people and contracting, little startups to do pilot projects just to kind of play around with this tech. It's now 6.5 years later. These banks are heavily investing in the technology and companies creating things with this technology. JP Morgan has launched their Bitcoin futures desk, and companies like Galaxy Digital, they are and will be the Goldman Sachs of digital assets. And so what this slide is looking at is no asset class is fully digital except existing cryptocurrencies. The only thing that's not possible to turn into a digital asset on a blockchain is physical cash itself. But every one of these yellow circles here represents an asset class that somebody somewhere to some varying degree of quantity and volume have digitized some of those assets on a blockchain. And it is possible to actually digitize all of those assets on a blockchain. The entire derivatives market could be on a blockchain. All global real estate could be. It's possible. And I think someday all of it will be. So if we think about the fact that it's today in sum total worth 1.9 trillion, that's nothing compared to the hundreds of trillions that it could eventually be. And then where I spend a lot of my time is thinking about how that digitization actually happens at a more granular level, and how we turn these physical traditional assets into these digital assets. And so this kind of shows a quick snapshot of that ecosystem that I live in and think about day to day. That's it. So, happy to take questions.
Okay. So I have a bunch. So if you could go kind of micro here for a minute and talk about Bitcoin itself. So the one thing that, I heard what you're saying about where the value is and all that. But the question I still have is, why does Bitcoin continue to rise and become so extremely valuable in itself? Is it because I'm not thinking about it as to what it really is, or is there? So if you can explain why does Bitcoin go up? I understand why blockchain goes up.
There's a few answers to that. I'm trying to think of the name of the law. There is a law that explains the correlation between network value, or why network value has the value that it has. And the way that this law was created, or thought of initially, and it's named after the person that came up with this, is that when AT&T started laying telephone line, phones started becoming connected, and we could make phone calls. When the first two phones were connected, the value of that network is very, 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 very low. But the value of that network increases exponentially. So as soon as you connect a third phone, you've got 3 connected. As soon as you connect 4, the number of connections that you can make doesn't increase linearly, right? So as you add 5 and 6 and 7 and 8 and 9 and 10, By the time you get to 10 phones, the value hasn't increased 10 times. It's increased like 100 times. And so, so this law that follows this exponential value growth is true of all networks. This is true of the number of users on Facebook. So if you look at the value of Facebook correlated to the number of users, it follows this law. This is true of all social networks. This is also true of Bitcoin. It's a network. So that's why people that analyze and trade Bitcoin look at number of active, monthly active wallets, daily active wallets, daily transaction volume, not transaction on exchanges, but transfers of Bitcoin between two wallets. All of these things are important because it indicates to those that care about the value of it, what that network is doing in terms of its growth or contraction. The other thing that people that project its future value long-term, and you can use this on kind of a swing trading, you wouldn't do it in a day trading way, but maybe on a longer timeline, there's an analysis called stock to flow. And the stock to flow model analyzes the amount of Bitcoin produced to the like velocity of it. And if you look up Bitcoin stock to flow, you'll see a ton of great research that's been produced. And what's interesting about stock to flow is that it is incredibly accurate. And unfortunately, I can't go into more detail than that just because I don't know a whole lot more about how to describe it. It's a technical analysis thing.
So just real quick, so it sounds, so I think you kind of answered my question.
Mm-hmm.
It's because I've been thinking about Bitcoin wrong. Bitcoin isn't a coin. It's right. It's a network, as you're pointing out. And so the reason the stock is going up is because it's the infrastructure of the network that's becoming more valuable because more people are connected and more people are trading on it. And so it's really the value of the network, not the coin.
Exactly. There's two other reasons too. Tell me one thing in this world that is truly finite. Definably finite, 100%.
I mean, you have plenty of resources which are finite. Yeah. Let's not forget about that.
Sorry, let me rephrase the question. Where we know exactly how much there is.
The amount of money in my bank account.
The answer to the question is Bitcoin is the only thing.
Okay.
Where we know exactly how much there is. There can ever only possibly be 21 million of them.
I would disagree with you, Adam, because taxi medallions in New York City for a while have been predetermined.
Yeah.
Limited in number. And so were many other things. Well, that's why at some point they traded at like $1.5 million.
Yeah. Technically, we could create more. It's possible, right?
Yeah.
And then the other reason why
in the human body.
What's that?
Chromosomes in the genome sequence. Chromosomes.
Yeah, but those aren't really tradable, right? We can't exactly trade those for goods and services, can we?
Say commodity. I guess you might have said commodity.
Yeah, I should have. And then the other reason why it has value is because of its security. So you may hear people refer to the fact that Bitcoin is immutable. And what that means is that it's something that is immutable means it's the most secure thing in existence. And there can only be one thing that's truly immutable. And to this day, Bitcoin is the most immutable thing that we know of. And
I would have to, I'm sorry to interrupt, but I would have to debate you on this one. Bitcoin may be immutable, but you do not feed off Bitcoin. You cannot buy produce with Bitcoin. You cannot put gas in your tank with Bitcoin. So there must be an interface from Bitcoin to the real money, and such interfaces exist. And this is where the weakness of Bitcoin reveals itself, because I don't think a week passes or a month passes that we don't hear the news of yet another exchange being broken into, or about yet another founder of yet another exchange pocketing all the Bitcoins and other forms of digital currency just disappearing, right? So
absolutely,
everybody
You're
keeps everybody keeps touting this as a gospel, like, oh, this is more secure, this is more secure. Yeah, computationally, given that Bitcoin, you call it network, essentially it's an endless system of equations, mathematical equations, if it comes to that. So yes, it may be immutable until such time that somebody figures out something, maybe with the help of quantum computers, right? How to sort of, just like people learn how to modify DNA genome. But I would agree with you on this one right now. But it needs interface to the real world, and that's where the exposure lies. So I don't know. I would debate any day in time. I would debate that Bitcoin is not safe, right? So Bitcoin as a resource, as something people want to hold on to generate wealth for themselves, it needs its proper manifestation in the real world outside of the digital domain.
Absolutely.
And so if that's not protected, and if you have governments that can tax it, they can tax this manifestations, then it kind of loses its luster.
Yeah. So is immutable, so therefore it has value, but can be unsafe if you do not go to trustworthy intermediaries in order to use it in a way that you want to, right? Absolutely agree with that. It's true. And this is why Gary Gensler at the SEC, what was it, about a week ago, said we need more regulation here. And yeah, I mean, we exchanges, because they are the on and off ramps, right? And that's where the regulators care the most about. That's how they know who's in and who's out of crypto and how much they're need to be taxed for their cap gains. It's where the value gets taken from the individuals. And the only way institutions are going to start doing it is if they know that it's highly regulated and they can trust these intermediaries. So yeah, we're going to see more regulation, and it will put those that have these concerns at ease. But it's things move slowly. The pace of innovation massively exceeds the pace of regulation, and so you're always going to have this bleeding edge of technology where things are unsafe and people lose money, lose their crypto, it gets stolen. Until regulation catches up, if it ever does. So, yeah.
Yep.
Hey, Adam, great presentation. I'm learning lots here. I got a couple of key questions though. Where is most of the $1,900 trillion? I mean, is 50% of it in China, or where is it? Just the big chunks? Or do we know?
We don't really know. We can, okay, so we do know, we can monitor. So because blockchains are publicly auditable, public blockchains are publicly auditable,
Okay.
we can look at the fact that there are some, early adopters of Bitcoin, for example, and people that invested very early in Ethereum. And we can see some wallets that have billions of dollars worth of cryptocurrency in them that haven't moved. Right. So we know that there are some people or maybe a company that are sitting on a lot of cryptocurrency.
Can you give us like the top 5 holders of this stuff? Because that's a lot of money.
So the top 5 holders of Bitcoin for the longest time were individual people.
Wow.
Now there's so much value that moves through cryptocurrency exchanges. The crypto exchanges are actually the ones sitting on some of the largest amounts of cryptocurrency at any one time. Some of it being their own and some of it being their customers. So if you just look at the blockchain, the ones with the largest balances are going to be the exchanges, but a lot of what you see is their customers' funds sitting in their exchange.
Do you know what countries are the top couple? I mean, I'm just wondering what this is going to do to our economy in the next 3 years, 5 years, kind of thing.
So the last point was that now hedge funds are some of the largest holders of cryptocurrency.
Interesting.
The thing is that, you know, a year ago, the market cap of crypto was, what, maybe, I think it was like 500 billion.
Oh, so at more than 300% increase. Wow.
Oh yeah, in the last year.
Wow, in 1 year. That's huge.
I'd have to look at the charts, but I mean, Bitcoin right now is 40 something thousand.
Ooh.
I think it was early 2021. I could have bought it for $3,000 per Bitcoin.
Oh
So
my.
we've like 15x
It is
like this year
40,000.
from the all-time low to the all-time high. Well, this
Wow.
year's all-time high was 60,000 per Bitcoin.
Oh
So
my
that was a 20x just in this year's all-time low to all-time high.
Okay, now this is,
Right.
you were bringing in accounting, so I've got to ask this. Is this stuff taxable? I mean, are we getting
course.
some taxable revenue from this? So it's kind of helping my tax situation?
So yes, people that bought Bitcoin when it was at 5,000 and sold it earlier this year when it was at, say, 50,000 had to pay cap gains on that.
Okay.
Now, if you do your research or you're smart about this, from a tax mitigation perspective, if I want to limit my cap gains that I pay, Bitcoin is not a security. SEC said so. So I can what's it called?
Is it
So
like
you're not
real
allowed.
estate? You can flip it?
So, well, for a while there, you could do a 1041 exchange with crypto, but now they're saying you can't.
Okay.
So with a security, you cannot sell it and then rebuy it within a 30-day window. With crypto, with Bitcoin, it's not a security, so you can. So I can actually sell my crypto and then 1 minute later buy it again. And on that sell, I can use that to write down my cap gains. I can actually write it off as a capital loss. But then I just rebought it back in a minute. And as long as I don't sell that for the next year, then I can actually write off a loss for that year.
Oh my. Okay.
So there's some
Interesting.
interesting ways to manipulate the way that you report to the IRS. But ultimately, if I then sell it the following year, then I'm going to have to, report my gains off my original basis.
Okay. Interesting. All this stuff is new.
Yeah, well, now you know why the regulators are getting in.
Yeah. Oh yeah. Because there's probably a lot of lost tax dollars on the table.
Yeah,
Probably, the IRS has their definitions, the CFTC, the SEC, and so and again, if you're trading it, if you're speculating it on it, then yeah, you have to be paying your cap gains there. But it can be treated as property or as commodity, and so how those things are taxed, it varies a lot. And a lot of people are using self-directed IRAs. A lot of people are using Delaware statutory trusts. And there's a lot of attorneys out there that I think have come up with really creative ways for people to mitigate their tax consequences.
Interesting.
One thing that I think is interesting that a lot of you as CFOs, I don't know if you're aware of, is companies holding Bitcoin on their balance sheet, right? Tesla, MicroStrategy, it's been rumored Facebook will soon. And so these companies are becoming some of the largest holders of cryptocurrency. MicroStrategy probably owns more Bitcoin than almost anyone in the world right now.
Adam, many thanks for a very interesting presentation. Are there any resources we can, read up on this thing? I mean, I've been part of the structured finance world, and I guess those were backed by real assets, housing, bonds. But if I just want to read on blockchain and digital assets, are there some websites which, give us a bit more detail?
Honestly, YouTube is a great resource. If there's anything that you want to learn, there's some simplified explainer video out there that can walk you through whatever it is you want to learn, and done graphically, so it's easier to grasp, because some of these things can get a bit complex. So that's, I kind of send a lot of people that way.
Any channels we should subscribe to? I'm sure there must be some experts out there, except the Kardashians. So sorry, bad joke.
It depends on what you want to learn.
Okay.
If you want to learn technical things, I could recommend a couple of people. It depends on what path you want to go. The fact that this cryptocurrency is often looked at as an asset to invest in. And so depending on how you decide to invest in that asset, kind of puts you down the path of, talking to your investment advisor, or your wealth manager, or going down the path of how do I secure, my private keys, which is totally, if you're going to hold it and do it, manage it all yourself, right? So these are two totally different paths and two different types of education. If you're going to go build something with it and actually, put software developers onto, creating something with the technology, then that's a totally different path.
Okay, I have another question. So you said that the Bitcoins, the number is fixed, which is like 21 million. So there was a story about this guy, I think in Ireland, who I guess trashed his hard drive, and then he was going through the landfill to find it because he had like 21 million, I guess, in Bitcoins on it. So, if we have if we have like 21 million Bitcoins out there, can suddenly the world lose 1 million and we are only left with 20 million?
So there's a lot of data analytics there's a lot of research that's been done on Bitcoin. And so many people have tried to determine approximately how many Bitcoin have been lost forever.
Oh, okay.
And we have a pretty good idea of what that is. And the interesting thing is that number will only go up over time. Now, it'll flatten out, of course, and has flattened out massively. But people will continue to lose Bitcoin because, it's like cash, right? Or it's like gold. If you lose your physical bullion of gold, like it's gone, right? Same thing here. It's gone forever. So we have a pretty good approximation of how much is lost forever, and it's around 10% of the total supply of the total. So say 2.1 million Bitcoin are gone forever.
Okay, so I think you also mentioned, and okay, so we have like only 1 minute left, but thanks for the presentation. I'm sure we're going to get the presentation, so more questions, we'll just reach out to you separately. Thank you.
Yeah. I mean, you guys, did you
just
guys all
wanted-
get my email address, and so we can
Yeah.
send me an email?
So we're going to hold the meeting open for a while. So
Yeah,
you don't have to worry about getting cut off.
I have a
Uh,
question for Adam, Jeff, if I could. Adam, are there any sectors of the economy, either public or private, that are resisting the adoption of this digitization of assets and blockchain and Bitcoin because either they feel threatened by it or just feel it's too risky to be used?
No.
So there's
Not in the
nothing
United States.
inhibiting the adoption of it. Why isn't it being adopted faster?
Why isn't cryptocurrency being adopted faster? Probably because of its volatility and security concerns. A lot of people don't want to hold it directly. They want to, because it's an asset without recourse. Most companies, I think, are too afraid to hold it directly. Because a very large company, it's only significant to them if they hold a large amount of it. And that makes them a target to hackers. And so they want a custodian to hold it. All custodians today that hold cryptocurrency are trust companies. And so a lot of companies, I think, are waiting for banks to be able to custody it. In Texas, banks can custody it now. In fact, well, maybe it might have been a federal thing, actually, so that all banks can custody cryptocurrency now. They have
Is
a
it
federal
insured
charter.
like FDIC?
No, you cannot. You can't insure it with FDIC. There are ways to insure it.
Yeah.
Insurance companies like Lloyd's of London can insure it in certain situations, like Coinbase and Circle, these big exchanges. I think their crypto is insured, but obviously it's not easy to get that insurance as a intermediary to access the on and off ramp of crypto and fiat. But the volatility, the security, the fact that custodians are only trust companies, and then also, so that's kind of like the asset itself. But then in terms of using the technology to facilitate transactions with counterparties, stable coins are evolving. They're getting there. USDC is the best thing yet. Visa just announced that they are going to be, was it Visa or MasterCard, announced that they are partnered up with Circle.com, the creator of USDC, and Coinbase also uses USDC as their stablecoin, right? So it's paired with dollars in the bank, 1-to-1 to the US dollar. I think it was Visa said that they're partnering with USDC to actually bring that stablecoin onto their payment network. So that's a big step. But in terms of sectors adopting, you're asking for counterparties, which often you're asking for competitors in an industry to agree to use the exact same technology. It's extremely difficult to do. And we've seen use cases, right? Like Walmart has their supply chain, some vendors in their supply chain, I think within like beef or fish or something, using blockchain technology. But that's just a tech for tracking a product, right? There's been some oil and gas pilots, Trafigura and I think it was BP and some other company, they did a transaction using some blockchain technology. But I ultimately say no. There's no limitations. There's no one that's saying they're not going to use it, because every major central bank in the world is discussing what we've referred to as CBDCs, central bank digital currencies. European Central Bank, our Fed, they're talking about it. Germany, France, like all these countries and that have relevant central banks in the world are all talking about it. And China's already rolled theirs out through numerous pilot projects. They have regular citizens like you and I interacting with their digital yuan. So the fact that every central bank is working on it, I don't think anyone's saying, no, we're not. They know they will. It's just a matter of time.
Thank you.
So Adam, back early on, you were talking about with blockchain that there's a hurdle if you're going to program in blockchain versus regular programming. What does that look like? What does that hurdle look like?
It just means we're hiring developers that have the expertise to build with blockchain technology.
So like
it's
over time, when the developing community gets good at it, is it basically going to be, you know, similar?
Yeah, I mean, what's nice is that there's blockchains coming out right now that are built for kind of all-purpose programmers. So a new blockchain that launched earlier this year is called Casper. It uses Rust, which is a programming language used by practically every developer on this planet. And the fact that you can build programmable financial contracts in Rust is huge. With Ethereum, they created their own scripting language called Solidity, and you had to learn their language in order to build contracts on their blockchain. That makes a very that puts a lot of friction, right? A high barrier to entry to build on that. So if you're, if you're a large corporation, a large U.S. corporation, you got to go find the guy that can build the thing, and he's got to have the right skill set. And so there's a lot of Solidity developers out there that are taking corporate jobs, and they're demanding anywhere from $300,000 to $600,000 a year.
Yeah.
Because they have this expertise. Like, oh, you want to build something on Ethereum? Okay, my salary is $500,000. Take it or leave it. But now you've got blockchains where like any developer can build on, and that's a good thing, you know.
Yep. Yeah. So that'll bring it mainstream. And so then that's how we're going to move more towards digitizing everything, right?
Yeah, and IBM, you know, played a big bet. I don't know, 4 years ago, when IBM chose Hyperledger as their blockchain of choice, and I think they allocated $1 billion budget to hire and acquire pilot projects with kind of the Fortune 1000 to go build and deploy as many blockchain applications as possible across the enterprise. And they spent $1 billion to do it. And the idea was that they get you hooked, right? We'll put some important process of this company's, business into a blockchain, and it's going to be built with Hyperledger where we, IBM, are the experts in it, and we employ all the people that are good at it, and now we got you, right?
Yeah.
And we're going to do it cheap because it's just a pilot, but now we got you, right? And so that was IBM's play at blockchain, and they're doing well with it, you know. So there's a lot of different ways that this is going to play out, and one's by like IBM enterprise solutions, but then, you know, decentralized public open source technology, you know, utilizing programming languages that any developer can build on too.
Yep. So,
Hey, Adam?
Oh, so go ahead, somebody else, yeah.
Sorry, go ahead, Jeff.
Well, I could just keep asking questions, so go ahead, Dave.
Yeah, I just wanted to ask about Bitcoin mining, because, you know, you hear these companies that are spending hundreds of thousands or millions of dollars mining Bitcoin. But if there's a finite amount of Bitcoin out there, what is it they're actually doing?
So what they do is compete to solve a problem, which in turn confirms the validity of the transactions in a certain period of time in order to be rewarded with Bitcoin.
Can you
So
explain that again?
approximately every 4 years, that reward gets cut in half, right? And And so there's a very simple equation that determines whether or not it's profitable to continue doing that. And so far it has been, and I don't foresee a day when it won't be.
So they're not increasing the supply of Bitcoin by mining it. If we think of mining in the sense of mining gold or other natural resources.
Yeah, I mean, it's similar to that, right? It's minting. They're often referred to as emissions, right? Because it's on this set schedule. We know exactly how much is going to come out, and we're competing for a piece of that emission, which are newly minted Bitcoins that get produced every 10 minutes. So when Bitcoin first launched, every 10 minutes, 50 Bitcoins were emitted as the reward to the miner that successfully solved this problem, which ultimately confirmed all the transactions in the prior 10 minutes. And then after 4 years, that reward cut down to 25 Bitcoins, 12 and a half, and then 6.25 will be next. And it'll continue going. They'll continue having until it reaches zero. Because Bitcoin is divisible to 8 decimal places, it doesn't finally hit zero because of all those decimal places, doesn't finally hit zero until around the year 2140. And already there are blocks where the value that the miners receive, part of it is the block reward, but another part of it is all the Bitcoins that were paid as a fee for processing their transactions. So anytime you send someone Bitcoin, you send them 1 Bitcoin plus a small fee to the miner. And so by the time, we'll get to the point really pretty soon where the reason why you mine is actually for the transaction fees and not so much for the Bitcoin reward.
Yep.
Adam, I have a question for you, or more just like an ask. I'm a little bit of a crypto nerd, but maybe for everyone here, would you mind describing the difference between like the capabilities of the Bitcoin blockchain compared to the ecosystem that the Ethereum block does?
The difference in the ecosystems?
Just like basically in the way, like, yes, Bitcoin is a store of value compared to Ethereum being almost more of like a new internet.
Yeah, I mean, so we touched on that a bit, right? How Bitcoin is a store of value. It's a form of money, right? Ethereum being kind of the default blockchain for if you're going to go build some applications, you're going to go build some business logic into your programmable money or asset. And that asset could literally represent anything you can possibly imagine. Even something that you've imagined that's never been done before. I guess the important thing here is that Ether, the fuel that drives transactions on the Ethereum blockchain, is a utility, right? You need it in order to, there's a reason it's called the fuel. Technically it's called gas, right? Whenever you send Ether or a token on the Ethereum blockchain, you have to pay a gas fee. And it's gas because it's what powers that transaction and makes it possible. And so you have this gas, this Ether, that fuels the computational cycles of a global decentralized computer, where you can run Turing compete business logic applications. And the thing on the other side of the transaction doesn't have to be a person. It can be code, it can be a computer. So really, if you think about anything that exists, any program, you could replicate it on top of this blockchain. And now we're seeing solutions come out that make that gas fee very, 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 very cheap. And so suddenly it starts to make sense to put more and more things onto this system. Tons of innovation happening in this space because people are taking concepts that they've wished they could do for years in the traditional world, and actually building them in this new decentralized world. So, you know, for years, the only thing we've ever known for trading things of value on an exchange is to utilize an order book, right? You have a buy side, you have sell side of an order book, and where it meets in the middle is your spot price. And that's the way it's always worked. And with Ethereum now, you have things called liquidity pools that use bonding curves in order to always have liquidity, no matter what the spread is on an asset. Really, really creative ways to use this technology to innovate the world of finance. So we've totally evolved the way that we have ever thought that a bid-ask spread works. Any other questions?
Yeah, Adam, thanks for an interesting presentation. So on that, it sounds like Ethereum, is that a more stable currency, quote unquote, than Bitcoin is? And I'm also curious your thoughts on what percentage of the people who buy cryptocurrencies, particularly Bitcoin, are investors who view it as an investment versus as a currency. I'm assuming it's the former, but I could be wrong on that. And for those who view it as a latter, view it as a currency, is there an expectation of a fixed, because it's weird to me, the concept of buying currency where, you know, based on value, that's very volatile. Is there an expectation of a fixed dollar, Bitcoin to dollar exchange? And if so, how will that play out? And also, you know, what would happen if the central government does come out with their own currency? What do you think will happen to the currencies, existing currencies, cryptocurrencies?
So I'm trying to recall what your first question was.
Sorry. Yeah, sorry. So it sounds to me from your explanation that the Ether or Ethereum is more of an infrastructure type of, you know,
right.
Yeah, go ahead. So they're more stable. Yeah.
So which cryptocurrency is the most stable? Bitcoin. All others are more volatile, right, in terms of their value. Bitcoin to US dollar stability. That's why we have stable coins. So there's a lot of different blockchains where stable coins exist. Ethereum is where most of them exist. And a stable coin, so when one is minted, there's $1 put into a bank account, kind of think of it that way. And these stable coins exist that way. Originally, they were made because if I'm trading Bitcoin, I don't actually want to send wire transfers back and forth from the exchange to my bank. It'd be better if the exchange could just tell me that, like, oh, here's this other cryptocurrency that is backed by $1 in a bank, and you can just sell your Bitcoin for that. And so we'll just make a currency pair out of these two cryptos, but one is just always $1, $1 US. That's how it started. But now, like if I wanted to receive my paycheck in USDC or USDT, which are just US dollar parity stable coins, I could just hold all my value, all my cash in a cryptocurrency, but it's always worth the same in US dollars, right? And so now, because my asset is already on a blockchain, I can move between all the other assets on all the other blockchains very, very easily. What was your other question? You had another one.
Yeah, I guess. Yeah, I didn't realize that I didn't realize that it actually is a fixed exchange, the dollar to the cryptocurrency. Okay, apologies for that. And so, and also, what do you think would happen once the central banks?
Oh yes.
Yeah.
So the Fed will end up rolling out a digital dollar. And when they do, it will be, as I've been saying for years, Bitcoin is complementary. It's not there to replace anything. I'd love it if it did personally, but it's not there to necessarily replace anything. It's complementary. It's your way to opt out of the existing system. And so when central banks issue their digital dollars, at first it'll be complementary. Like you can kind of pick and choose, right? If you want to put cash in your wallet, you can. But we all use, every one of our bank accounts, we have an app for it, right? And we see the value of what's in our bank account in that app. So if it says that I have X dollars in my personal checking account, if those dollars were actually tokenized onto a blockchain, I would use it the exact same way I always have. If I send you money over Venmo, maybe I could send them to you in digital dollars issued by the central bank, and it would work the same way it always has on Venmo. So you and I won't really feel the difference. But what it does that's fundamentally different is that the central bank knows exactly how much money you spent at the grocery store. And they don't need the banks as much as they maybe will used to have needed them in order to get dollars into your hand. That's very different.
Thank you. And also thoughts on current percentage, and I'm sorry for oversimplifying this, of Bitcoin purchasers or holders that are actually investors. I'm assuming a large chunk, but
yeah, I mean,
yeah,
like pretty much 100%.
Okay, thank you.
Okay.
And just one comment on that, like, why is it 100%? It's because these are people that think that this whole system I've described today is inevitably where all this is going, and that all this existing infrastructure we've been using, it'll go away.
Yeah, that makes sense. We didn't even have credit cards at one point, right?
Yep, exactly. Exactly.
And
We will continue to evolve, right?
Yeah.
Credit cards will not be here forever.
Yeah. I mean, I don't even know the last time I wrote a check. Never happens. So yeah, it'll go.
Well, thank you guys.
Thank you, Adam.
I'll send this PowerPoint over to Jeff, and Jeff, you can send it out to everybody. And my email address is in there if you guys want to follow up with me.
Cool. Yeah,
Okay.
and what I'll do is I'll post it on the FENG website with the PowerPoint, or actually Lori or Joyce will. But
Okay.
it'll be out there. And also,
great.
Yeah. So anyway, thank you very much. This is really fantastic. I now can say I pretty much understand what's going on. I need to digest some of this, but I'm getting it.
YouTube is your friend. It's just
yeah.
You have a question, think of it, type it, and somebody is on there explaining the answer to your question.
Yeah, right. Okay.
All right. Thank you, guys.
Thank you.